Welcome, everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance. As many of you are aware, the SBIA is the advocacy association for investment professionals focused on America's lower middle market companies. Our association has maintained a key role in promoting the growth and vitality of this industry and the small businesses that it supports for more than 60 years. We're pleased to bring you our Lunch and Learn webinar series with today's topic, the Main Street Lending Program and the Middle Market. Our series of webinars is designed to provide useful educational content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. A few housekeeping items at first. If you have any questions for our speakers during the session, please use the chat feature in your GoToWebinar menu bar. We will monitor this section and address questions at the end during Q&A. Also, please use this feature to let us know if you're having technical issues, and today's technical director, Ainsley Hoffman, will reply with suggestions. Also, please note that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded without approval by SBIA and Eversheds Sutherland. Today's session is possible because of the support of our longtime sponsor, Eversheds Sutherland. Eversheds is a global top 10 law practice comprised of more than 3,000 lawyers delivering multi-jurisdictional legal services. Eversheds Sutherland has a nationally recognized investment management practice with particular experience in structuring SBIC subsidiaries of business development companies. Joining us today, we welcome firm partners Cynthia Cruz and Jean Waters. Cynthia and Jean counsel companies and alternative investment funds as they work to grow their businesses, particularly in the area of raising capital. They also work with management teams and boards of directors on strategic planning and timing critical decisions in all aspects of their businesses, including mergers and acquisitions, proxy contests, going private transactions, reorganizations, debt, equity, and rights offerings, and other securities and capital markets transactions. Before we ask Cynthia to begin her presentation, it is also my pleasure to welcome two of SBIA's council chairs to today's panel. Michael Gerber from FS Investments serves as chair of the BDC Council, and Brad Tribish from CVS Capital Partners serves as chair of the SBIC Council. Today's webinar serves as the July gathering for all of SBIA's council groups. The councils will resume their monthly calls in August. Michael, may I ask you now to make a few introductory remarks?
Yes, well, thank you, Mary Brown, and Cynthia, to you and your team, thank you. You guys have always been terrific supporters of the industry, and hosting events like this is a big part of it, so we really appreciate that, and I look forward to your remarks. The team at SBIA, Brett, Palmer, Connie, and others, along with several of our board members, Ian DeAngelis of Stellus, who will be our next BDC Council Chair, Ian Simmons of 6th Street, who is my predecessor in this role, and others like Vince Foster from Main Street, who's been involved for a long time, has spent a good deal of time evaluating and trying to help shape this program to reach as many companies as possible and help folks manage through the crisis. The Main Street lending program's clearly off to a slow start, and it's not yet serving up to its intended purpose, but we're hopeful. Recent Wall Street Journal article reported that only 300 of 11,000 eligible lenders have started the process of registering to participate. So that's less than 3%. Many borrowers aren't participating for a variety of reasons. From a BDC perspective, there are a few aspects of the program that prevent many BDC portfolio companies from participating, meaning there are thousands of businesses and millions of employees employed by those businesses that may very well be left out. But we're encouraged that Fed Chairman Jerome Powell expressed in a recent congressional hearing that he's open to modifying the program. So there's hope for the BDC community and the country as a whole that the program will ultimately live up to its intended purposes if needed. And of course, the SBIA team and our board members will remain engaged on behalf of the membership and all of our portfolio companies. So with that, I'm pleased to turn it over to my friend Brad Trivish, who serves as our SBIC Council Chair at SBIA.
Great, thank you, Michael. I'd like to thank my colleagues on the SBIA Board of Governors who are working diligently on issues affecting our industry. While they are not on today's call, I'd like to thank Alex Abel, who serves as a Limited Partners Council Chair, and Doug England with the Eversheds Company, who is a Council Chair for the Middle Markets. All the Association Council Chairs lead their sectors with a steady hand in leadership. It's a pleasure to welcome everyone, and I share my thanks to Cynthia and the entire Eversheds Sutherland team for their participation today and for this valuable information. So Cynthia, if you're ready, virtual podium is yours.
Great, thank you very much. And we'll jump right into it and talk a little bit about what the purpose of the Main Street lending program is. In April of 2020, the Federal Reserve announced that the Main Street lending program, a multi-facility $600 billion lending program intended to make additional credit available to small and medium-sized businesses so that they could maintain operations and payroll during the COVID period. The Treasury Department will make $75 billion equity investment in special purpose vehicles in connection with the program using funds appropriated to the Exchange Stabilization Fund under the CARES Act. That's 8-time leverage. To participate in the program, the eligible borrowers will apply for and obtain loans directly from an eligible lender. This is the first time the U.S. has done this since the Depression. The eligible lender will then in turn sell 95% participations in the loan to the SPV and retain the remaining 5%. And as you already heard, it's actually been a long time coming since this was announced in April. Just yesterday, the Fed in Boston announced that the program was actually operational and could purchase loans. So what facilities are included in the program? There's actually 3 different loan facilities, which sometimes makes it a little bit confusing. There's the new loan facility, the priority loan facility, and the expanded loan facility. So what are the differences between those 3 facilities? The eligible lender and borrowers are the same. The criteria is the same. They also have several features that are the same. The maturity date, the interest rate, the deferral of the principal for 2 years, the deferral of interest for 1 year, and the ability of the eligible borrower to prepay without penalty. The facilities differ, however, how they interact with your outstanding debt, including the level of of COVID indebtedness. Jean, can you give us a little more detail about the facilities?
Yeah, so starting with the key terms of the new loan facility, here eligible lenders extend new 5-year term loans to borrowers ranging in size from $250,000 to $35 million. The maximum size of the loan, when added to the borrower's existing outstanding and undrawn available debt, cannot exceed 4 times the borrower's adjusted 2019 EBITDA. The loan must not, at the time of origination or at any time during the term of the loan, be contractually subordinated in terms of priority to any of the borrower's other loans or debt instruments. We'll go into more detail regarding the new loan facility later in the program. Moving to the priority loan facility, here eligible lenders extend new 5-year term loans to borrowers ranging in size from $250,000 to $50 million. The maximum size of the loan, when added to the borrower's existing outstanding and undrawn available debt, cannot exceed 6 times the borrower's adjusted 2019 EBITDA. At the time of origination and at all times thereafter, the loan has to be senior to or pari passu with, in terms of priority and security, the borrower's other loans or debt instruments, with the exception of mortgage debt. At the time of origination, the eligible borrower under the priority loan facility is permitted to refinance its existing debt owed to a lender that is not the eligible lender, so a lender other than under this program. We'll go into more detail about the priority loan facility later in the session as well. And lastly, moving to the expanded loan facility, here lenders increase or upsize an eligible borrower's existing term loan or revolving credit facility. The upsized tranche is a 5-year term loan ranging in size from $10 million to $300 million. The maximum size of the loan added to the borrower's existing outstanding and undrawn available debt cannot exceed 6 times the borrower's adjusted 2019 EBITDA. So this is just like under the priority loan facility. Also, at the time of upsizing and all times thereafter, the upsized tranche has to be senior to or pari passu with, in terms of priority and security, the borrower's other loans or debt instruments other than mortgage debt. Likewise, we'll go into more detail regarding this expanded loan facility later in the program. Cynthia, can you discuss whether there have been any terms of the program that have been controversial to date?
There have been several. One, targeting too narrow a group. Some analysts have noted that the potential borrowers with a clear path to success after COVID will likely be able to secure loans from banks on less restrictive terms than under the current program, while borrowers without cash and no likelihood of recovery post-pandemic will not qualify. This has been one of the reasons that you have seen at the initial announcement on the programs, the terms have been changing and morphing over time. So the Treasury has been taking into account some of the challenges or controversy in trying to make it a more attractive program. But it's uncertain how much more they're going to change the terms. However, they have said that they will continue to adjust the terms as needed. There's also restrictions on capital distributions and stock repurchases. These apply to borrowers not only during the term of the loan, but also a year after. And then there's also the application of the SBA affiliation rules. So the program brings into account different provisions that the SBA programs have always operated under. And so you have to be familiar with both this program and that program in order to understand. Just to talk for a minute about some of these provisions, is the restricted stock, the distributions, and executive compensation. For restrictions on stock repurchases, borrowers cannot repurchase any nationally listed equity security of a borrower or any of its parent entities unless contractually obligated to, during, as I said, during the pendency of the loan and then for a year after. There's also restrictions on distributions. Borrowers can't pay dividends or make other capital distributions. However, the Treasury has indicated there may be some ways around that limit. Note that borrowers that are S corporations or other tax pass-through entity may be able to make distributions to the extent they're required. However, there still is some uncertainty around REITs and RICs. Restrictions on compensation. Officers and employees who receive more than $425,000 in total compensation cannot receive more than that, and they also have restrictions on their severance. Officers or employees who receive over $3 million are also restricted, and the way you actually calculate total compensation is set forth in the materials as well. So how is this program different from the PPP program? The Fed has made clear a number of times that this is not a forgiveness or grant program. This is a loan that is expected to be repaid. And they make that over and over, even in their announcements yesterday. The maximum loan sizes are quite a bit different, as you can see on the screen. The conditions of the program also differ, including the certifications and application process. Recipients of PPP loans are eligible to participate in this program in certain limited circumstances. So how long will this program be in effect? It'll be in effect, at least as of today, until September 30th, 2020. The SBVs will cease purchasing loan participations on that date unless the program's extended. The Federal Reserve of Boston is running the program and will continue to operate the Main Street SPV after such date until the SPV assets mature or are sold. Has the program been launched? As of yesterday, yes. The program is fully operational and ready to purchase 95% participations in eligible loans. The Fed has encouraged eligible lenders to start submitting qualified loans. Lender registration opened in mid-June, and as you heard, only 300 institutions have actually applied for participating, and the Fed has been somewhat discouraged by that, and it's gotten off to a very slow start, even when you're talking to some banks about people inquiring, borrowers inquiring on whether they can participate. Registration instructions and the form of loan participation agreement, form of borrower, lender certificates, covenants, and all the required forms are available on the Federal Reserve Lending Program page. There's FAQs that are available. They're 63 pages long. So if you were wondering whether this is a government program, it is absolutely a government program. So the Fed also announced yesterday that they would be publishing what institutions are participating on a state-by-state basis in the coming days. Jean, we'll start talking a little bit about the eligible lenders. So who are the eligible lenders under the program? The eligible lenders on the program include the U.S. federally insured depository institutions, banks, savings association, credit unions, branches of those institutions, bank holding companies, savings and loan holding companies, intermediate holding companies, and subsidiaries of any of those. Are non-banking institutions or BDCs eligible to participate today? The answer is no. And you already heard that the Federal Reserve is actually reconsidering that. Hopefully they'll come out with that on the positive side. If you go on to the next slide. For example, I'll go through why we would think a BDC would be a good lender in the circumstance. One, they were created during the same type of a historic downturn in the 1980s as now. BDCs also helped out and filled a role where the banks had receded in 2008. They have knowledge, experience, and expertise in middle market lending. It's unclear why they would be left on the sidelines, as well as other non-bank lenders. Will standard loan documents be provided for program loans, or should lenders use their own loan documentation? Each participating lender should use its own loan documentation in relation to program loans. This documentation should be substantially similar, including with respect to required covenants, to the loan documentation that eligible lenders use in an ordinary course lending to similarly situated situations, adjusted only as appropriate to reflect the requirements of the program. I would suggest that it'll be very interesting to see how the Fed interprets all of these various programs and requirements, and it applies the SBIA provisions. Jean, would you talk about eligible borrowers?
Yeah, thanks, Cynthia. So who is eligible to borrow under the program? At the outset, we'll note that borrower eligibility is the same for all three facilities in the program. To be eligible for a program loan, a prospective borrower has to be a business, and it must have been established prior to March 13, 2020. It cannot be an ineligible business under the SBA's affiliation rules, and we'll get into what that means in a little while. It has to have 15,000 employees or fewer, or have 2019 annual revenues of $5 billion or less, after aggregating the employees and revenues of the business with those of its affiliates. It has to be a U.S. entity created or organized in the U.S. or under the laws of the U.S. with significant operations in and a majority of employees based in the U.S. Continuing on to the next slide, it has to participate in only one of the program's facilities, meaning the new loan facility, priority loan facility, or the expanded loan facility. And it cannot also participate in the primary market corporate credit facility, which the Fed created to help support large companies. It cannot have received support pursuant to Subtitle A of Title IV of the CARES Act, which provided support to airlines and businesses that are critical to maintaining our national security. And lastly, it has to be able to make all the certifications and covenants that are required to be made by a borrower under this program. Moving to the next slide, here we get into what is an ineligible business. Now, a lot of you are probably familiar with this, given that it has the same exact meaning as under the SBA regs and guidelines that implemented the PPP. So here we've listed the types of businesses that are ineligible. For example, financial businesses primarily engaged in the business of lending, such as banks, finance companies, and life insurance companies. Businesses located in a foreign country. Businesses deriving more than a third of gross annual revenue from legal gambling services. Businesses engaged in any illegal activity or any pyramid sale distribution plan. Continuing on to the next slide, private clubs and businesses which limit the number of memberships for reasons other than capacity, any government-owned entities, any businesses in which the lender or any of its associates own an equity interest, adult entertainment businesses, which you may have seen have been in the news in relation to the PPP program, and we'll get to that in a little bit more detail later in this session. Businesses primarily engaged in political or lobbying activities, and speculative businesses. Moving to the next slide, Cynthia, can you talk about whether a private equity fund is eligible for a program loan?
Unfortunately, the answer is no. The Federal Reserve has confirmed that private equity funds are not eligible to borrow under the program because they're considered primarily engaged in investment or speculation, which is a type of ineligible business under the SBA regulations. In addition, investment advisors generally are not considered eligible either for the same reason. However, there has been some controversy over this, and as you saw that yesterday under the PPP program, there were several investment advisors who did receive loans. So it'll be very interesting to see how all of this is applied by the Fed and the SBA, because again, the Fed has not necessarily been in the business of applying these requirements or rules in the past or pursuant to this type of a program. In connection with the PPP, have ineligible businesses challenged SBA restrictions in court? The answer is yes, and Gina already referred to there was a strip club that actually was granted a PPP program or got to keep a PPP program loan as a result of a court case. In addition, there's been some discussion around someone who has a criminal conviction, and that's actually been changed so that it's only applicable if it's been in the past 5 years for a narrow category, which is different than the SBA program. In addition, there's some workarounds regarding bankrupt businesses and that type of thing. So there has been a fair bit of court cases or litigation already. And I would expect you're going to see similar type of issues crop up here. So how should the borrower count employees for purposes of determining eligibility under the program? As we mentioned, a borrower with 15,000 or fewer employees can participate in the program. The eligible borrower should count the employees all full-time, part-time, seasonal, and otherwise employed persons, excluding any kind of independent contractors or volunteers. Eligible borrowers should count their own employees and those employed by their affiliates. To determine the applicable number of employees, use the average number of the total persons who are employed by the business and its affiliates for each pay period over the past 12 months. And I went past the word affiliates, which is really one of the issues we're going to get into a little bit later. Also, you have to determine, going on the next slide, how you calculate 2019 revenues for purposes of determining eligibility under the program. As mentioned, a borrower with 2019 annual revenues of $5 billion or less can participate. To determine its 2019 annual revenues, a borrower must aggregate its revenues with all of those affiliated, and it may use either of two methods. Either the borrower may use its revenue that it had in 2019 for under GAAP, or the borrower can use the annual receipts for the fiscal year as reported to the IRS. If the borrower doesn't have that, they need to use their most recent financial information. Coming back to the affiliates issue, which entities are the borrower's affiliates for purposes of employee revenue eligibility criteria? Under the applicable SBA rules, which applies here, entities are affiliates when one controls or has power to control over others, or a third party or parties controls or has the power to control both. So that's very clear. So the SBA rules go on to talk about various scenarios where you find affiliation. Affiliation based on ownership. So if the ownership is over 50%, or if you have certain veto rights, or the affiliation arises under stock options, convertible securities, or agreements to merge, and those apply as if they were concluded or exercised. Going on to the next slide, affiliations also based on management. Means if the CEO or the president of a company controls the management of another entity, you would have to add those together. Affiliation also rises when the same individual or company controls the board of directors of 2 or more companies. And finally, the affiliation rises if the individual or company controls the management of another company through a management agreement. In addition, affiliation based on identity of interest. If you have 2 companies where they're the same industries, the same geography, and they have a overlap of 20% equity interest, you also have affiliation. So these rules are extremely technical and actually created a lot of problems for the private equity industry in trying to come up with how to interpret the PPP program. And I imagine that this is going to continue to be an issue for companies trying to apply. But in a private equity situation, I think that was mentioned up front, if you have a controlled portfolio company and that company is applying and you control other entities, you have to add together all of those employees as well as revenue. So the SBA has established some exceptions. However, I'd suggest to you in this context, they're much less than the PPP program. So you have to be very careful in analyzing, and this is a borrower requirement. You have to analyze the structure of your entity. So you need to go to somebody who understands these roles. Jean, would you like to talk about significant operations and what that means?
Yes, thanks, Cynthia. So to determine if a borrower has significant operations in the U.S., its operations should be evaluated on a consolidated basis together with its subs, but not with its parent companies or its sister affiliates. An eligible borrower has significant operations in the U.S. if, when consolidated with its subsidiaries, greater than 50% of the eligible borrower's assets are located in the U.S., its annual net income is generated in the U.S., its annual net operating revenues are generated in the U.S., or its annual consolidated operating expenses, excluding interest expense and any other expenses associated with debt service, are generated in the U.S. Moving to the next slide, we ask whether a U.S. company that is a subsidiary of a foreign company can be eligible for a program loan. And the answer is yes. An eligible borrower can be a subsidiary of a foreign company, provided that the borrower itself is created or organized in the U.S. or under the laws of the U.S., and the borrower on a consolidated basis has significant operations in and a majority of its employees based in the United States. However, we should highlight that the proceeds of a program loan can only be used for the benefit of the eligible borrower, its consolidated U.S. subsidiaries, and other affiliates that are U.S. businesses, and it cannot be used for its foreign affiliates. Moving to the next slide, we touch on the issue that Cynthia discussed a few moments ago. So the question here is a portfolio company of a PE fund eligible to borrow under the program? So as Cynthia mentioned, status as a portfolio company of a private equity fund doesn't disqualify the portfolio company from getting a program loan. However, the affiliation rules do pose a significant obstacle to eligibility, as the portfolio company's employees and 2019 annual revenues have to be aggregated with the employees and 2019 annual revenues of the portfolio company's affiliated entities, And here we've provided an example that goes through this. So let's just go through this quickly. Assume a portfolio company aims to borrow under the program. The portfolio company here has less than 15,000 employees, and its 2019 annual revenues are below $5 billion. So what that makes clear is that it would be eligible on its own. However, let's assume that a PE fund owns more than 50% of the voting equity of the portfolio company, as well as that of several other companies. Due to the affiliation rules, the portfolio companies, the private equity funds, and the other companies that are majority owned by the PE fund are all affiliated entities. So in order for this portfolio company to borrow under the program, it has to meet one of the following 2 conditions. Either the aggregate number of employees of the portfolio company and its affiliated entities must be 15,000 or less, or the aggregate 2019 annual revenues of the portfolio company and its affiliated entities must be $5 billion or less. So you can see how that might be difficult to satisfy in certain situations. Moving to the next section, we're talking about the terms and conditions of the program. Cynthia, can you go through what some of the general terms and conditions applicable to all loans under the program are?
Sure, and just to walk through these, and we tried to highlight here the changes that have happened, because there's actually been 2 or 3 sets of FAQs and term sheets and that type of thing that have been coming out. So we even had to update these in the last couple of days. So the maturity is 5 years. Initially, that had been 4. There's been some suggestion that that should be even longer. The principal payments will be deferred for 2 years. That was changed from 1 year. The interest payments will be deferred for 1 year. And then each loan or upsized tranche has to be originated after April 24th, 2020. Each loan will be amortized over the remaining term, with the 15% of the principal due at the end of each of the 3rd and 4th years, and a balloon payment of 70% due at maturity. Loans will be made at an adjustable interest rate of LIBOR, 1 or 3 months, plus 300 basis points, which is 3% today. That was changed from the adjustable interest rate of the SOFR plus 250 to 400 basis points, and we'll get into that in the next slide or so. The SPV will purchase at par, 95%. If you could go back on the slide. At 95% in the loan, the SPV and the lender will share the risk in the loan on a pari passu basis. The lender must retain its 5% loan until the maturity, or the SPV sells the participation, whichever comes first. And that changed under the priority facility, that you were required to maintain 15%. So that was a welcome change. And then there may be prepayments without penalty. And these are the full recourse loans, as I mentioned earlier, and the principal amount cannot be reduced through loan forgiveness. If you could go next page. And just to mention some of the other types of things that you would normally see in a middle market loan, PIK can only be for the first year. There's nothing in the FAQs or the term sheet about floors, and you can provide for default interest. So I do believe that a lot of these terms are going to be fleshed out in more detail as the Fed gets more accustomed to these types of loans. So going on, the new loans range in size, just under the new loan facility. If you could go back one. So the size, a minimum of 250,000 to a maximum of lesser of 35 million, or an amount that, when added to your debt, does not exceed 4 times the borrower's 2019 adjusted EBITDA. That minimum was decreased from 1 million to 500,000, and then to 250,000 to make it more accessible. And then the maximum amount was increased from 25 to 35. The loan is not at any time during the term of the loan contractually subordinated in terms of priority to any of the borrower's other loans or debt instruments. We'll talk a little bit about contractually subordinated in the next slides. Any existing loan that the borrower had outstanding with the lender as of the year end must have had an internal risk rating that's based on the lender's risk rating system that will be the equivalent to pass in the supervisory rating system as of that date. Something would have to be looked at if you had non-bank lenders. Going on to the next slide, what is the effect of the requirement under that facility not to be contractually subordinated in terms of priority to other loans or debt investments? One thing I mentioned is that contractually subordinated is not a term that you're going to find in most other commercial middle market loans. So in the FAQs, they had to explain the meaning. It may not be junior in priority in bankruptcy to eligible borrowers, other unsecured loans or debt investments. The provision does not prevent the issuance of a loan that is secured, including a second lien or other capacity, whether or not the eligible borrower has outstanding secured loans of any lien priority. The provision does not prevent the issuance of a loan that is unsecured, regardless of the secured or unsecured status of the eligible borrower, existing indebtedness, or the eligible borrower from taking new secured and unsecured debt after receiving the loan, provided that the new debt would have to be higher contractual priority in bankruptcy, would not be higher, in bankruptcy than the loan that was just taken out. So this is actually in the FAQs if you want more detail about that. Going on to the terms of the conditions of the loan under the priority loan facility, the new loans under this are basically, they start at a minimum of 250 to a maximum of 50 million, or an amount that when added would be 6 times the adjusted EBITDA. That again was modified and decreased from 500 to 250, and the maximum was increased from 25 to 50 million. The loan at the time of origination and at the time of during the outstanding loan, it has to be senior to or pari passu with the terms of the priority and security of the borrower's other loans and debt instruments other than mortgage debt. Any existing loan that the borrower had outstanding has to be have an internal risk rating of pass. And at the time of the origination of the loan, the borrower may refinance its existing debt, which you can't do under the new facility. Going on to the next. What is the senior to or pari passu mean? Since that's not necessarily something that's, again, built into commercial middle market loans. The loans and upsizes under the priority loan facility and the expanded facility, which we'll talk to next, are required to be senior to or equal with, in terms of payment priority and security, the eligible borrower's other loans and debt investments. Notably, all loans may be senior or unsecured. However, the expanded loan facility must be secured by the same collateral package, if any, as the underlying loan. The requirement that both priority loan facility and expanded loan facility loans be pari passu with existing secured debt will trigger the need to determine any limitations on incurrence of pari passu debt or liens and related procedural requirements. In scenarios where credit agreements do not include specific mechanics for additional pari passu debt, amendments and consents will need to be sought. We'll talk about the expanded facility. The eligible lenders may upsize an existing term loan or add a new term loan tranche under an existing revolving facility to qualify the existing term loan or revolving credit facility that remains has maturity of 18 months or more. Upsizing loans ranging in size from a minimum of 10 million to a maximum of lesser of 300 million, or the amount of the EBITDA adjustment by 6 times. The minimum loan amount was increased from 1 to 10 million. The maximum amount was increased from 150 to 200, and then again to 300 million. The upsize tranche is, at the time of this upsizing, it has to be senior to or pari passu, as we've already talked. The existing terms of the loan or existing revolving credit must have had an internal risk rating of pass, as we've already mentioned. Why are these loans based on LIBOR rather than SOFR? Going on to the next slide. The initial iteration of the program based loans on SOFR, which is the alternative to LIBOR as expected to be. However, the Federal Reserve revised the program based on feedback it received from potential participants, noting that implementing the system would require diverting resources in the banks from the challenges they already have around the COVID pandemic. However, the Fed has suggested that any lender or borrower include fallback language, even though they're using LIBOR today. Do PPP loans count as outstanding debt for purposes of the program? Yes, they do. The portion that's outstanding that has not yet been forgiven has to be included. Jean, do you want to talk about the certifications under the program?
Yes, thanks, Cynthia. So eligible borrowers are required to make certifications under the program. And here we've listed out the types of certifications required. First, the borrower has to agree that it will not repay the principal balance of or pay any interest on any debt until the loan is repaid in full, unless the debt or interest payment is mandatory and due. Also, as we discussed previously, the priority loan facility does allow a borrower to refinance its existing debt owed to a different lender at the time of the origination of the loan. The borrower also has to agree that it will not seek to cancel or reduce any of its committed lines of credit with the lender or any other lender. The borrower has to have a reasonable basis to believe that as of the date of the origination of the loan and after giving effect to the loan, it has the ability to meet its financial obligations for at least the next 90 days and does not expect to file for bankruptcy during that time period. Continuing on to the next slide, as we previously discussed, the borrower has to agree that for the life of the loan and for 1 year after repayment, it will follow the executive comp, stock repurchase, and dividend and other capital distribution restrictions that are applicable to direct loans under the CARES Act, with the exception of tax distributions being allowable. The borrower also has to certify to its eligibility to participate in the program, including as it relates to the conflict of interest prohibition under the CARES Act, which prohibits certain governmental officials from participating in various federal lending programs. Moving to the next slide, are eligible lenders required to make certifications under the program? Yes, just like borrowers, lenders have to make the following certifications. The lender has to agree that it will not request that the borrower repay debt extended by the lender to the borrower or pay interest on such outstanding obligations until the loan or the upsized tranche, as applicable, is repaid in full unless the debt or interest payment is mandatory and due, or in the case of defaults and acceleration. The lender also has to agree that it won't cancel or reduce any existing committed lines of credit to the borrower, except in the case of default. The lender also has to certify that the methodology used for calculating the borrower's adjusted 2019 EBITDA for the loan's leverage requirement is the methodology that is previously used for this borrower when extending credit to it, or to similarly situated borrowers on or before April 24th, 2020. And the FAQs for the program note that similarly situated borrowers are meant to include borrowers in similar industries with comparable risk and size characteristics, although the FAQs don't go into any further detail. The lender also has to certify to its eligibility to participate in the program, just like we went over for the borrower, and that includes as it relates to the conflict of interest prohibition under the CARES Act. Moving to the next slide, we ask whether there's a requirement under the program to retain employees. So under the program, each borrower has to certify that it will make commercially reasonable efforts to maintain its payroll and to retain its employees during the term that the program loan is outstanding. So this was changed from a prior version of the program where a borrower had to certify that it required financing due to COVID and that using the proceeds of the program loan, it would make reasonable efforts to retain employees. So this is a bit of a lesser standard that's required under the current iteration of the program. The Federal Reserve also provided additional background on this point in the FAQs by stating that the borrower should undertake good faith efforts to maintain payroll and retain employees in light of its capacities, the economic environment, its available resources, and the business need for labor. We should also note the borrowers that have already laid off or furloughed employees as a result of COVID-19 caused disruptions are eligible to apply for a program loan. Moving to the next slide, Cynthia, can you talk about how 2019 adjusted EBITDA is calculated? I think you may be on mute, Cynthia.
Sorry, is that better?
Yeah.
Under the new loan facility and the priority loan facility, an eligible lender must use the methodology it previously used for adjusted EBITDA when extending credit to eligible borrowers or to similarly situated borrowers on or before April 24th, 2020. Under the expanded loan facility, it's a little more strict. The methodology has to be used, what you used in connection with that actual loan when you're originating it or amending it before April. What if the eligible lender has used multiple EBITDA adjustment methods? The FAQs come out and say effectively it has to be the most conservative method. So it's no more detail than that at this point. The transaction origination fees under the programs, under the new loan facility and the priority loan facility, the lenders will pay the SPV a transaction fee of 1%. However, they may very well get the borrowers to pay that. The borrowers also will pay the origination fee of 1% on the principal amount. And then under the expanded facility, it's a transaction fee of 75 basis points and origination fee of 75 basis points paid by paid the same way. There really are no other fees under this program other than there is a servicing fee of 25 basis points. And the only other thing you can charge for is effectively de minimis services like legal guidance and that type of thing, but it's not really defined in any more detail, de minimis under the program. So this is another area I think there's going to be a fair bit of discussion. As I mentioned earlier, just going on to the next slides, the potential litigation. This is a government program, and as a result, it operates pursuant to the standards and requirements. And as a result of that, any provisions or statements that are made potentially could come under the False Claims Act. If either a lender or a borrower was to knowingly make a false statement that encompasses a reckless disregard or deliberate ignorance of the requirements, there may be issues around that. Any certification or representation made by a borrower or lender in the application process also could give rise to a False Claim Act liability as a fraudulent inducement. To avoid this, eligible borrowers and eligible lenders really need to be careful and understand the program and make sure that they're aware of the guidance and they keep all their records in compliance. Now, this may be a little bit different than the PPP program, which we've already seen that there have been some issues around, that there are not the same requirements for effectively doing the PPP program. Here you've got effectively minimum requirements that the banks can apply their underwriting rules. So there might be a little bit less exposure, but it is going to be very interesting to see how this all plays out. Jean, can you just mention the application process, which will bring us to the end?
Yes. So we touched on this earlier, but as far as what loan documentation is required to sell a participation to the SPV, the Federal Reserve Bank of Boston's legal forms and agreements are all available on the website that the Federal Reserve Bank of Boston has set up for this program. And the website includes the form loan participation agreement, borrower and lender certifications and covenants, and other related documentation that is necessary to effect the sale of a qualifying participation interest to the SPV. And then we ask the question of what information will the Fed disclose regarding the program facilities. So this is expected to be much like what just happened yesterday for the PPP. The Fed has said that it will disclose information during the operation of the facilities, including the names of lenders and borrowers, amounts borrowed and interest rates charged, and overall costs, revenues, and other fees.
So that brings us to the end of our discussion today. There's going to be a lot more discussed. There's going to be a lot more to come on how the SPVs operate and how they apply the various requirements from the Fed, from the SBA. It'll be very interesting. There actually hasn't even been a loan made yet under the program, so we're really at the outset. So we'll hold for a minute to see if there's any questions, and then we'll bring this to an end. So we've got quite a few questions. What I would say is that we're going to try and answer a couple of them right now, and then we'll go ahead and try and respond to folks if you've given us your information, or post them maybe on the SBIA site. The first question, and I think we answered this, but we'll answer it again, make sure everybody heard it. Is there a list of participating lenders available yet? Jean?
Yes, so It isn't available yet, but the Fed said yesterday in its announcement that they're working to post a list in the coming days that will note all of the lenders participating that have elected to disclose their participation. So I think your first step would still be to reach out to the lender that you've used in the past and ask them if they're participating, but hopefully we'll have this fallback of a list of those lenders that are trying to publish their participation sometime this week, we would hope.
So there's a number of questions that folks have posed that have to do with the SPV and how it's going to operate. And I would suggest we may very well come back and do another discussion since there's a lot of detail around that. Another question is that there's a couple of them that have come up on the SBICs. So SBICs can't necessarily participate as far as the fund is concerned. They're borrowers. There really shouldn't be an exclusion other than the affiliate or associate issues that we already discussed. And technically those shouldn't apply here, but that's something that's still, I think, not 100% clear from the FAQs, but it's and under the PPP program, there were special exclusions. That does not apply here, to be clear. Can an applicant with no debt receive funds to hold as cash and use later for acquisition or greenfield, or does it violate the spirit? Interesting question. There's actually a fair bit of discussion around whether you could use the funds for mergers or acquisitions, and the answer so far has been maybe. It depends on whether you can meet all the other requirements and whether you meet the bank's underwriting requirements. So it's a possibility. Can the Main Street program be used to refinance seller debt? I think we already answered that. And I don't know, Jean, if you want to mention it, it may be treated differently depending on which loan you're looking for.
Right, so that is permissible under the priority loan facility, and under that facility, at the time of origination of the new loan under the priority loan facility, you can refinance the borrower's existing debt that it has with a different lender. So not the lender that's gearing up to make the program loan under the priority loan facility, but that is the only facility where you have that option.
Another question is presumably if a borrower is sold prior to maturity and the loan is paid off, the shareholders can take distributions from the sale, and it's just no distributions if loan repaid and the company continues. I would suggest to you that they have not commented on that, and I would suggest it's going to be something that's going to have to be interpretation over time. But it would make sense if the company was sold that you wouldn't necessarily have to maintain that restriction. However, as long as the SPV does own the loan, they have said that there very well might be those requirements might continue. So I think that there's some conflict that might be created. Another one, does the capital distribution rules for 1 year after the loan is paid off apply if the business, never mind, sorry, I think we already answered that one.
I think there's the one on what is the process timing for obtaining SPV approval. We intend to have this requirement in our term sheets and credit agreements as a condition precedent to funding. Thus, this will be a key issue we need to discuss with the applicants. So the FAQs for the program have stated that lenders are not required to commit and pre-fund loans under the program before the SPV has committed to purchase its participation. So there are two options. The eligible lenders can either extend the loan and seek to sell a participation to the SPV, or they can sign a commitment letter with the borrower with the SPV's participation as a condition to funding.
And the last question we'll take right now is, can you elaborate on the ineligible borrower exclusion, businesses in which a lender or an associate owns? So just to be 100% clear, the ineligible borrower exclusion is basically an SBA regulation, and we went through the different types of businesses that the SBA has not allowed to be allowed to get loans. And then you've got the whole affiliate issue, which really goes to control, and the rules go to every different type of control, I would suggest to you. And if, so one, the borrowers and the ineligible businesses are just excluded 100%. The second point is affiliation, is where if you go over the 15,000 or the 5 billion, that's the limits under these programs as far as who can participate. So we can certainly try and provide more detail, but those are the outline or the criteria. So I think that's everything for today. We appreciate you spending some time with us, and I think we're going to come right up on the hour.
Yes, thank you, Cynthia and Jean, and thanks to our council chairs as well. We appreciate the time and expertise that you have all so generously shared with us today. In closing, we would just ask that you mark your calendars for our next Lunch and Learn session, which is scheduled for next Wednesday, July 15th at 12 noon Eastern Time, where we'll cover M&A investment considerations in the COVID-19 environment. Please note that there is an updated time and date for this webinar. And finally, a recording of this webinar along with the presentation deck will be distributed to SBIA members. If you're not an SBIA member and would like to learn more about joining our organization, please contact my colleague, Alexandra Frick, at membership@sbia.org. Thank you again, everyone, and we look forward to having you join us again next week.
Thank you.
Thank you.